Hello everyone, welcome to this webinar. Very warm greetings. Thanks for joining into this webinar. So we are pleased to announce the launch of Mirae Asset Long Duration Fund. I am Shredding Daga, part of products team at Mirae Asset Mutual Fund. And with me is Ms. Kruti Chheta. She is a fund manager and fixed income analyst at Mirae Asset Investment Managers Private Limited. And she has been managing Mirae Asset Banking and Debt Fund, along with she'll also be managing Mirae Asset Long Duration Fund. So, Kruti, just to give a background to this webinar, we have seen over the past 25 years or so, interest rates have seen a significant decline from almost around 20% levels to 7.5% now. Similarly, even the inflation trajectory has come down significantly from say 15% to 6.5% currently. So, do you see this trend continuing? And from that perspective, how do you see the interest rates and inflation going ahead, and what factors, in your view, would drive this trend? And if you can also draw some parallels from other economies globally, which have seen similar trend and which can be compared with India. So over to you, Kruti.
Thanks, Shreya. Thanks for the introduction. If we see, India now has become a structural story, and like you rightly pointed out, that we have come a long way where we've seen interest rates at 12%, and we have then seen a gradual decline to 8%. And then 7.5, and now, close to seven. Below seven is what the new level that we are seeing. And we've also seen that the inflation, which had been highly volatile in the previous times, because there were a lot of factors. Obviously, no economy can stand alone in when there is a globalization, but the impact reduces over the period of time as we learn how to, manage through the volatility. In 2014, your inflation targeting came into the play, where there was an MPC committee which was formed, and the primary task of the MPC committee was to keep the inflation within the range of 4 to 6%. For a developing economy, that seems to be a very good range for a developed economy. Obviously, the targets have been around 2%, but we have to understand that as an economy grows, there is going to be some volatility that comes into the market, and therefore the range that is set for us as a developed market is 4 to 6%. So the committee was formed in 2014, and there, since we have seen that the inflation has stayed well within the range bound, and we have done that job beautifully of managing it within the inflation target of 4 to 6%, barring the times when there were COVID, where we saw the fluctuation, and it was not only domestic, it was global in nature, where we saw best of the economies which were at a sub 2% had seen a inflation of 9% plus. But when those economies continue to see volatile time, we fairly stabilize. Yes, we've seen the recent two prints coming in a little higher at 5% plus, or the last one coming 6% plus. But this is a seasonal in nature, and it's already discounted for the market. It was already flagged in by the MPC. But year on, if you see the target that RBI is seeing, or the forecast that RBI is seeing, we are seeing that for FY24, the inflation is set to be at 4.5%, which is actually at the lower end of the inflation targeting. And for FY26, we are seeing at 4.1%. Why this becomes important is that as an economy grows in size, as an economy grows GDP wise, we see that the volatility tends to decrease in the inflation. And as the volatility in the inflation decreases, we see that the interest rate also structurally come down. We have come a long way, but from here on, it seems that the base is set, that we are ready for another structural move. If we are moving to an inflation of a 4%, which is at the lower end of the RBI target range, then we will see that the other factors will come in, where For example, we are seeing a little growth slowdown right now. So, if the inflation is stabilizing overall, then we will see that the growth will become the flavor of the narrative rather than inflation being so. Inflation has been a very long fight globally. Some of the countries are still fighting it, but we have maintained it very beautifully. And from here on, we just see the stabilization of those numbers rather than volatility on those numbers.
Sure. So, Kruti, from a consumer pattern perspective, are you seeing any changes? Is it more towards discretionary, or it's more still continuing with basic needs? And from that perspective, how it is important from interest rate view?
So, like we were talking about inflation, and an important component of inflation today, why it is so volatile, is your food basket, which is approximately 40% weight of your total inflation basket. But if you see a consumer spending now, we have to remember that this basket was formed 10 years back, a decade back, when the consumption patterns were much more different than what it is today. Today, it is an aspirational India. It is moving up. We are seeing that most of the people are coming in the service sector. Obviously, we are not completely yet there. We have grown in GDP by the size, but per capita remains still far away from even getting close to the developed nation. That is another long that we need to go. But in meanwhile, because of the power of the social media, because there is a second generation which is seeing a stable income, we've seen the spending pattern is changing in India. So when we say that the spending pattern is changing, we are seeing that more and more, income is going towards discretionary goods that can be reflected by. If you see, compared to like the chart shows that personal loans were around 26% in FY19, which was just pre-COVID. But after COVID, we have seen that it has moved to 30%. It only shows that people are more spending on discretionary items, which could be your white goods or maybe for a travel purpose or so on or so forth. But the spending pattern is clearly changing in that time. We've also seen that the shift has moved from a hatchback or a sedan to an SUV. The SUV consumption in India has just gone back, and we've seen that a lot of the travels have also picked up in last post COVID. So we are definitely seeing that the consumption pattern is changing. And what we are trying to essentially say here, that if we are moving towards a economy where your consumption, where your basics are taken care of, if your food is taken care of and you're not worried too much about spending a larger portion of your income on the basics of it, then there is always a room to toggle around the discretionary items, because those are not necessities. You can postpone it if the situation doesn't account for, and therefore your retail basket going ahead, when it is reset in the upcoming years, it will be less volatile compared to what it was when it was a decade back, the basket which was set. Speaking more on how your retail basket could affect more, so there is a lot of work that has been done by the government, apart from inflation targeting, which has been done beautifully by MPC. There's a lot of work which is done by government also in order to manage the supply chain. Obviously, it is a work in progress, and but we've seen so many of the measures coming through. Like we have seen that we have increased the warehouses, because we know that the top vegetables, which is tomato, onion, and potatoes, at least onion and potatoes are something that you can preserve. So we have increased the warehouses so that any seasonality which comes in, we can release the products from there. We've seen that the buffer stocks of rice and wheat have gone up by rice is 4 times from the current need that is expected. And we've also seen that we have managed diplomatic relations with other economies, where we import from their pulses, which are more friendly with us, where we can import from those, so that the supply chain is smooth and it does not disrupt. So we have come a long way in supply chain management also. And apart from your spending, which might decrease in these basics, we will see that even because of the supply chain smoothening out, there will be less volatility, seasonal volatility in these baskets.
Sure. So, do you think any government capex and private capex do have a role to play here from a growth trajectory as well as from a interest rate trajectory?
The government capex has kicked off last two couple of years. We have seen that India has talked a lot about government capex, and it has gone in the right direction where the allocations have been higher. But the past studies say that, if we have to go from a developing nation to a developed nation, government alone, a government can bring in regulations, government can bring in money, but there has to also be support from the private capex. So this slide beautifully shows that when China in its growth phase, the government capex kicked in higher, which helped to accelerate that growth. So for India, it has fairly been stagnant so far. And if we want to hit that nominal GDP growth of 15%, which is a target for us to become a developed nation, we'll probably have to give incentives to the private sector also, so that they come in with a capex and we can accelerate the growth from year on, and also generate more employment. It's a economic circle that we need to get in. Government has already set in, but we need private sector also to come in to support this growth narrative.
Sure. And I guess even US and economies like Japan have seen similar trajectory in terms of growth, inflation, interest rate. So as they move up the economic ladder, you tend to see inflation, interest rates going down. And that is what even what you have talked so far about, it is hinting towards that.
So the slide shows a classic example where we started from. It shows that your GDP growth increase, and as your GDP increases in size, the volatility becomes lesser and lesser. US is a classic example. From here, we can see a Japan chart also, which shows that as the GDP increases, your volatility decreases in inflation, and so does your interest rate decrease. For India, obviously, we still have a little way to go to become a developed nation. There is no doubt about that. But structurally, we see that we are moving in the right direction because we have taken care and we have formed the base in terms of inflation, where we have become a range bound and we are moving towards a lower, of a 4%. We've seen that the fiscal deficit discipline has been at the maximum. We've seen that we have maintained it below 5% for last couple of years. Even in COVID, we were very cognizant of how we were spending rather than just giving out like other nations were doing so. And one of the beautiful examples has been that CAD, which usually used to be a concern, and at every geopolitics, the CAD used to be one thing that used to pop out in every narrative, that the commodity prices from year on are expected to go higher, and therefore our CAD will hit. And we have gone to about 2%. 2% used to be the new normal, and we've seen it hitting -4, -6, or so on. But even during the times of wars, geopolitics, or uncertainties in last couple of years is very recent, but we've seen that our CAD has been stabilized at around 1%, and we don't see that from year on, we see there is going to be a blowout in CAD. We see that it will be fairly stable. So this gives us a lot of comfort that the direction is set right, your factors are in place, and from here on, the base is set for your structural move, the next shift for the Indian economy as a whole.
Sure. So, over the last 1 year or so, we have seen inclusion of Indian government bonds in global bond indices, the likes of JP Morgan, Bloomberg, FTSE Russell. So, what do you make out of this, both from a short-term as well as from a long-term perspective?
So we have seen inclusion in the global bond indices and other indices also, where some are in talks and some have already come in. Yes, it is an added benefit. Yes, it adds to the demand dynamics of the Indian. But we need to remember that we are still very conservative on the foreign flows in our GSEC markets. We've never been fully opened about it. And in today's date, also, if we see the percentage of the total investment of the total outstanding government bonds, where the FPIs are there, it is only barely 2.4%, so nearly less than 3% overall, even after inclusion, the bond indices halfway through, we've seen that, it has added around 5% right now. And we've seen that a lot of FPIs poured in money from January, from March onwards to front run this entire narrative. Um, Will it have has it had an impact in last 1 year? Yes, it has had a positive impact, but also to understand that the supply has also been limited, so the demand has outpaced supply. We believe that the next year is also going to be similar, where the demand is going to outpace supply. But in a longer run, yes, if we intend to go more, or the government needs borrowing, now it has support that if we are fundamentally right, and if the macroeconomic factors remain stable, there will be more demand that will be created from the opening up to the global markets. We had seen China, obviously, property crisis has been an other exception because of a difficult time. But other than that, we've seen that since the inclusion has taken place, there's been a lot of FPI money coming into the market. We are comparatively new. We have just opened up. China also took the entire process, like approximately 7 years it took to open up, put the regulations in place. We took our good run. It's been 3 years, but we will see more money coming in from FPI in the government bond segment also, and this just helps us to enhance the demand against the limited supply that we have and we see in the foresee future.
Sure. So, given the current situation, what we've seen, the 10-year benchmark is currently trading around 6.85%, 6.9% levels. Uh, how much of the rate cut is already priced in, and how do you see this from a 1 year or a similar period perspective, and even from a longer term perspective, where do you see interest rates and policy rates from here on?
So, there's always a typical thinking that the longer end of the curve runs faster, and there is always, discount of what is going to happen in future is discounted in the longer end of the curve. True, not false, but if you see the instances which are marked in the red circles, it shows that when the rate cut or the rate hike cycle kicks in, it is not that the story for the long end of the curve is over. If you see the 10-year benchmark, it plays out along with it. So from that perspective, if we say currently, is it entirely discounted? We also have to understand one thing, that last year largely has been a function of a demand outpacing supply. So there has been an added benefit to the view that there are going to be rate cuts. Now, the year that we are going to move into, we are moving ideally into a situation where the demand is going to continue to outpace supply, because the large demand is from the domestic players, which is still very stagnant, and we are not moving up from that demand. But the added benefit is going to be rate cuts to that demand. So we see from here that there is still flavor in the longer end of the curve, and so far we've seen the positive of a demand supply dynamic playing out. The rate cuts benefit are still yet to kick in, and we will see the interest rate coming down on the longer end also with it.
Sure. I guess what we have seen similar trends even in the past, be it GFC or COVID period, we have seen repo rate and 10-year moving along, and the market trying to preempt those rate actions.
Absolutely.
So, Kruti, coming to the main moot point here, uh, how do you see a long duration fund mainly from a risk reward perspective at the current juncture? And if you can elaborate more on whether it makes sense to invest in a long duration fund, both from a tactical as well as from a structural perspective.
So, long duration fund, we launch it at a very interesting point right now, where we see that an investor who is very well aware of the market and how the market movements are happening can take a tactical call. But also, this fund plays a very good role in an investor who is looking at a stable future income. Now, when we say, let's look at the first set of the investors. The first set of the investors are the ones who are very learned, and they know that, how the economic movements are happening, what is going to impact the rates, and how the interest rate are expected to move. For these guys, this is a good time, and in light of the entire global setup that is happening, there is a good opportunity which has been created amidst all the volatility that is happening to enter into this segment and reap the benefit out of it. Now, the second set of the people for which actually this fund makes a lot of sense is the people who are looking for a stable income, who are probably more than a wealth creation, they want a wealth protection in their portfolio, and they're looking at the stable income over the period of time where they could easily create liquidity for themselves whenever they want. So for this set of people, essentially, this product makes sense because we are talking of India as a structural story. We are talking about India, which has moved from a 12% to 7% now. And we don't see any reason why this 7% should not go down to probably a 5 or a 5.5 over the period of time as India moves up the GDP ladder, becoming top three in probably next 5 years or so on. So, in order to create that benefit of the accrual, this is a good time for them to lock in at a seven handle coupons and take the benefit of that going ahead also. So they have a capital gain on their side, and as well as they have the higher accrual on their side. So if you see this table, we've this is based on the CRISIL long duration index, and over the 10 year of a period, we've seen that if an investor has stayed invested, and again we are talking about an asset which gives you stable income, over the period of 10 year, it has generated approximately 8.3% CAGR. So this is the stability that this product can provide to you if you give an allocation to it. And if someone is playing a tactical call of 1 or 2 years, who knows where the interest rate cycle is headed, then they are likely to make a return of 10 to 12% playing the interest rate cycle. But if you see the extreme right change in 10-year benchmark, over the 10 years, we have seen that structurally the 10-year benchmark has come off, 150 basis down from the previous levels.
Sure. So, one question, especially post the taxation change now, that mutual funds are taxed at marginal rate. So, is there any added benefit for any investor who is investing into a debt mutual fund versus other traditional fixed income investments? If you can elaborate or explain on that.
So, after the change in the indexation, obviously there has been very obvious questions that why not a traditional investment rather than going for a mutual fund. We see it as all the asset classes have got it at a par. Now all the taxation the same across the asset class. Now an added advantage of having a mutual fund, a debt mutual fund over a traditional investment is for a debt mutual fund, you get taxed at the end of the period when you decide to redeem your funds. Till then, your accrual goes in full. You get the full benefit of your capital gains, and it gets reinvested fully. Compared to what your other traditional assets are, where you get tax quarterly. So that much of the accrual you are losing on, and to one surprise, over a long period of time, because we are talking about a long duration fund, and the investors would be locking in for a longer period of time. Over a longer period of time to your portfolio, it can make a difference of around 80 basis to 1%, depending on your reinvestment risk. But if you are a longer duration person, and if you are looking for a stability of income, this is one product to look at compared to your traditional investment. Because if you're talking of a structural story, then there is a reinvestment risk which would be occurring to you depending on how you're investing, 1 year or a 5 year. You would be investing lower if you are structurally looking at a downward interest rate cycle, and that is a loss that you would be taking apart from the taxation if you're invested for a long period of time.
So that's a very important point. So apart from this added tax advantage, even reinvestment risk could be significant, which can eat into your returns.
Absolutely.
So, Kruti, talking about our Mirae long duration fund, what would be the strategy of this fund? If you can just explain briefly how you'll be managing this fund, if you
Sure.
can throw some insights.
So, the long duration fund, the minimum, as the category says, the minimum duration that is allowed into this fund is 7 years. 7 years of modified duration. So obviously the securities are going to be longer, but since we feel that we are at the edge of the interest rate cut cycle, we would want to take maximum benefit of it. And because we see that global also there will be volatility, but it's positive directionally, and for domestic also it is positive directionally. We would like to go more aggressive in the investments right now and take our duration to the highest, which would be 11 year plus. um, Apart from structurally keeping the portfolio largely in place, unless and until we see that there is a reinvestment risk which is coming on the surface and we need to restructure the portfolio, we would not see essentially to rebalance the portfolio very actively and entirely. But the need comes and we see that there is, interest rate risk which is coming in, then we would not hesitate to take an active call and go down on the duration also. And meanwhile, any opportunities which come in, so your 90% of the portfolio stays largely structurally aligned, but there could be a 10% of the portfolio which we might, rebalance in order to create and generate additional alpha for the investor based on the events and the convictions that we have on those events.
Sure. So I guess as you mentioned, just to summarize, uh, first of all, while it makes sense for a tactical allocation, even from a strategic allocation, it can be part of one's core asset allocation. And someone who is looking for more relatively less volatile returns, more stable returns, can look at this product, and even this can get aligned to longer term financial goals like retirement, marriage, child's education, etc. And even investors who are looking for opportunities to capture the prevailing high yields can look into this product from that. And of course, tax deferment is a added advantage even post the taxation change. So, uh, Kruti, what we've seen, especially post US election, there's been a market narrative that the rate cut by US Fed would not be to the extent what it was initially anticipated. And from that perspective, how do you see monetary policy stance both at US front as well as from a domestic front?
There has been a lot of noise on the global developments in election, that the new regime that is set in to come next year might be inflationary in nature, might be a fiscal blowout in nature, and there could be a lot of tariffs which might be imposed, which would impact the decision of rate cuts in the Fed. But if we see the narratives that have come in after the election results, we've seen that the committee has been set to improve the government efficiency. So if we see top of it, the agenda is that we need to cut down the government expenses. Because Elon Musk and Vivek Ramaswamy has been appointed for it, and Elon Musk has a proven record of cutting down the expenses when it took over X, when it first launched its SpaceX. We've seen that he was highly disappointed with the expenses that were going in, and he actually brought it down to half of the cost which was initially estimated. So there is quite some bit of the record that he has already proven to have in terms of cutting down the taxes. The initial narrative that we have heard from him is that we need to cut down on the government jobs and we need to cut down on the defense expenses. And not to forget that this administration during the campaign has advocated for stop war in Ukraine. So if the situation is that there is going to be stopping of the war, we will see less of the fluctuation in the commodity prices globally. and if we are set to see that there are going to be job cuts, then there is going to be unemployment rate which is going to increase. Now, unemployment rate increasing 4% currently, unemployment rate in US is high from the standard that they would want of a 3.5%. That 4% blowing up further uh, 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 would create alarming situation for Fed. So essentially, we are looking that inflation has stabilized for now. And if we see Fed's commentary also, it says that the core inflation, which is there, the PCE core inflation, the new reset levels are now at a lower than what it used to be during COVID, and it has now settled back to pre-COVID levels. So we are seeing that fairly the stabilization in the inflation is happening. Probably from year on, the gradual decrease might not be substantial, but at a 2.5%, 2.5% is still a stable inflation from there. The growth seems to be right now moderate for them, but if we are seeing that there are going to be job cuts, there are going to be government expenditure cuts, there will be less consumption in the economy, and there would be effects of it which will trickle down in the economy, and we'll see that the growth might also get impacted. And third is that if unemployment rate is going anywhere above 4.5%, then we will see that that also creates a situation for Fed. So essentially down the line, what we're talking, when the new regime takes up, the three targets of Fed which is there, that is inflation, growth, and unemployment. Your unemployment is going higher, your inflation has stabilized, and your GDP might see a slowdown. So then eventually, if not immediately, they might be forced to take an aggressive steps rather than going slow on it. Probably we'll see that till the regime takes over and the actions are not in place, there would be some caution around it. But once we know it in action, then only we'll know the impact of it, and we'll start actually seeing the impact in the numbers also. That is when we see that the more aggression will happen. And most of all, when we are talking of rate cuts, we've seen even last year when there were no rate cuts, and to this cycle when the rate cuts started, the end target or end of 2025, where we see most of the Fed members agree that the interest rate should be between 2.5 to 3.5%, with majority of them being closer at like a 3% range. So we know that the path might be volatile, but the target is something that they already have in their mind, and they need to get to that target, and the situations will occur in such a way that it will help them getting to that target easier.
Sure. Thanks, Kruti. So we would like to open for Q&A now. So till the time questions are available in the chat box, one more question which obviously comes with a long duration fund is investors can also go through RBI Retail Direct if they want to take a duration call and invest directly into government bonds. What is your view on that?
So definitely investors, if they want to, and they can go, but the challenge in that situation is that as an investor, depending on whatever appetite that you're investing, first of all, the minimum for a liquidity for an on the run security is minimum 5 crores, the lot of 5 crores and the multiples of 5 crores. So if an investor is looking at a 5 crore and multiples of 5 crores plus, then they can go and invest on the on the run securities. But any investor who is looking at a smaller quantum than that, then there is a challenge in creating the liquidity. Also, to point out that today the security which is on the run, next year it will become off the run. So investor might find a challenge even if they have quantum to liquidate those securities, because the new securities have come in. So in that situation, again for them a liquidity becomes a challenge. So we always say in debt that it is easy to get in the debt market, but the challenge is always to get out, and this is where we come in. Obviously this is a very clean portfolio, this is a portfolio which is only interest rate rather than a credit risk, but in that interest rate also you need to create a liquidity which it would be much more easier through a mutual fund, because we do have systems in place rather than going and buying in a portal. If you're an investor who's decided that I want to invest in a 30-year security and I'm waiting till the end of it to redeem, then yes, you can do that. But if you're an investor, you think that you need liquidity at any point of time, then you should consider a debt mutual fund.
Sure. So, one of the questions I think we have already addressed, but if you would like to respond on it again, uh, uh, basis, do you see RBI may see may take a longer pause than what was initially anticipated, and from that perspective, whether it makes sense to invest in a longer duration fund or a short duration fund, what would be your response to that?
So if you're an individual who is playing out an interest rate cycle, then long duration fund is something that you should be looking at. Yes, there has been a situation which has been created where there is a volatility in the market and the narratives have been, coming adversely. And US perspective, we've already covered that when the regime comes into the action, then only we'll see that, how the things are trickling down. So as for RBI, and we've talked initially of inflation, which we see that it is the RBI's target for, or the estimate is 4.5% for this year, and for next year it is 4.1%. So assuming that we are looking at inflation of near 4%, and your interest rate is somewhere around 6.5% today, based on inflation and real rate, it becomes a clear case of a rate cut from here on. And another added incentive for RBI to go for rate cuts is that they have maintained that this year's target of growth at 7.2%. In the earnings, in the narratives, in the numbers, we have seen that the slowdown has already happened. This was being questioned to the MPC members 2 policies back, and they maintained that 7.2 was it. Probably because they saw that the inflation volatility was to come, the seasonal inflation volatility is to come. Uh, so they maintained that growth target, but now the numbers are actually showing down, and it's matter of time that we see that the RBI and the MPC members also correct on their growth numbers and bring it down lower. For India to reach the top three, we essentially need a nominal GDP growth of 15%. Because of the global slowdown, because of the events that have happened, we have settled at a nominal GDP growth of around 12%. But anything which is coming down below double digits, which we are seeing a situation right now that it is coming down, if we are at a 6.5%, or let's say, close to less than 7%, then it becomes a situation where there will be a push from the government also. Not saying that like RBI will not take preemptive steps. We've seen that the MPC has been preemptive entirely. It has waited for the inflation to stabilize, and as we see that the next few prints stabilize, we will see that the narrative will change. But yes, for foremost for them was inflation, which was a global narrative also. As that stabilizes, we will see that the narrative changes to growth, which is now becoming a concern in numbers itself, and it's matter of time that it turns to that. And once that turns to, and also that we want to get the private capex in, is another incentive added for the growth momentum to keep going. So all these directionally pointed that RBI would be eventually, and a change in the stance last policy shows itself that they were prepared for it. The global situation that has changed would make them just cautious, or they would want the situation to pan out. But I think the action is already set in the mind that where they want to head.
Sure. Kruti, if you want to highlight any risk with long duration fund, what in case if, while it may not be the most probable case, what in case if, since RBI would be going in for a shallow rate cut, or do you see a scenario wherein interest rates will again rise?
So if we see in a near term and the entire base which is set, we don't see that in near term. We are seeing that the interest rates will rise from here unless and until globally there is a change that is happening and we get into a difficult situation. Then we might see a hike, but structurally and supportively, we don't see that, there should be any hikes in near term.
Sure. And how different would be a long duration fund from, say, a target maturity fund? What could be the incentive for an investor to look at a long duration fund than a target maturity fund?
A target maturity fund essentially is locked in into a particular period of time, and you can redeem. Investor who's very clear about that they want to lock into those securities only, they can look at those product. Nothing wrong in that. For a long duration fund, we actively manage while the structural position is communicated and remains largely same. The extra alpha generation on event based is something that becomes an added advantage to the investor in this.
So there's a very basic fundamental question here. What if modified duration is 10 years, and if you see 100 basis points interest rate fall, what would be the likely capital gains?
So 50 basis is the base case that we are taking right now, that there might be a cut of 50 basis. On that, we see a capital gain of 4.5 to 5%.
Sure. With a modified duration of 10 years.
10 years might be a capital gain of 4.5%.
Sure. Sure. And do you envisage running any kind of barbell strategy in this fund going ahead in any scenario, or it would be more of a 90-10 call, as you mentioned?
This because the fund structure and the minimum modified duration is to be maintained at a 7, so there wouldn't be a barbell strategy. This would be a long only fund.
Sure. So there's a question in terms of deployment of NFO funds. So how long it will take for you to deploy those funds once the NFO closes?
Maximum 2 days.
Sure. So I guess there are no further questions. Kruti would request for your closing remarks.
We pretty much covered why we think that, why this is the right time and what kind of investors can look into this fund. But only to point out that there has been volatility right now, and every volatility becomes an opportunity for an investor. So, uh, would like investors to think that this is an opportunity. Last year was a miss for most of the investors who thought that there would not be rate cuts and capital gains, but in spite of no rate cuts, we've seen capital gains. We see a clear path set over here, so investors who are looking into these categories should try to maximize out of it.
Sure. Thanks, Kruti. Thanks for great insights. Thank you, all the participants. Thanks for joining into this webinar. Hope you find it useful, and we look forward to your participation. Thank you very much. Have a nice evening.
Thank you, everyone.